Welcome to today's video where we dive deep into the investment world, VIG, FDVV, and for tuning in, viewers. If you're finding this content valuable, are a type of security that involves a collection of securities, like stocks, that often tracks an underlying index. They're a fantastic way to diversify your investment portfolio, offering you a piece of a broad market sector without the need to buy each individual stock. Today, we're setting our sights on 3 dividend and growth ETFs that have been making waves in the investment world: VIG, FDVV, and DLN. VIG, the Vanguard Dividend Appreciation ETF, FDVV, the Fidelity High Dividend ETF, and DLN, the Wisdom Tree US Large Cap Dividend Fund. Each of these ETFs brings something unique to the table, and we're excited to dissect what makes each one a compelling consideration for your portfolio. Stay tuned as we explore the unique attributes of VIG, FDVV, and DLN. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. First on our list is VIG, or the Vanguard Dividend Appreciation. Focus on long-term performance is what sets VIG apart is its performance over the years. Since its inception in average ETF. Its expense ratio, meanwhile, is a modest stock. It's about building wealth slowly and steadily. As you consider your investment options, remember this. It specifically targets companies that have consistently increased their dividends over time. In other words, it's not just about the here and now, but about a company's track record of growth and stability. This focus on long-term performance is what sets VIG apart from many other ETFs on the market. One of the key features of VIG is its broad exposure to a diverse range of sectors. From technology to healthcare, from consumer goods to industrials, the ETF covers a wide spectrum of the market. This diversification reduces the risk of being overly exposed to any single industry, making it a solid choice for those seeking a balanced investment strategy. Another standout aspect of VIG is its performance over the years. Since its inception in 2006, it has consistently delivered solid returns. In the past 10 years alone, it has seen an average annual return of over 6%. These figures speak volumes about the ETF's ability to weather market ups and downs and to deliver reliable returns over the long haul. When we look at VIG's yield and expense ratio, we also see some attractive numbers. The ETF boasts a yield of around 2%, which is competitive when compared with the average ETF. Its expense ratio, meanwhile, is a modest 0.06%. This low expense ratio means more of your investment goes towards building your wealth rather than being eaten up by fees. But what does all this mean for you as an investor? Essentially, VIG offers a way to tap into the potential of companies that are not just profitable now, but have demonstrated a commitment to growing their dividends over time. It's a strategy that aims for consistent, reliable returns, rather than chasing after the latest hot stock. It's about building wealth slowly and steadily, rather than taking big risks for potentially big rewards. In conclusion, VIG stands out for its focus on companies with a track record of growing their dividends year after year. Its broad exposure, strong performance, competitive yield, and low expense ratio all contribute to its appeal as a dividend and growth ETF. Whether you're a seasoned investor or just starting out, VIG offers a compelling option for those looking to balance income with growth. So, as you consider your investment options, remember this: investing is not just about making money quickly. It's about making smart decisions that will pay off in the long run. And in the world of dividend and growth investing, VIG is one such smart decision. VIG stands out for its focus on companies with a record of growing their dividends year after year. Next, we have FDVV, also known as the Fidelity. In essence, FDVV offers a balanced mix. Historically, FDVV has demonstrated a strong, especially beneficial in uncertain market conditions. As for the quantitative approach to select stocks, focusing on, in conclusion, the Fidelity High Dividend ETF, income-focused investors. If you're looking for a way to enhance with a chance to tap into companies that are expected to pay hefty dividends, many of these companies are well established and are often leaders in their respective industries. In essence, FDVV offers a balanced mix of value, stability, and high yield, making it a compelling choice for income-focused investors. The Fidelity High Dividend ETF is also known for its diversified portfolio. It invests in a wide array of sectors, including but not limited to information technology, healthcare, and consumer discretionary. This broad sector allocation helps mitigate risk and provides the potential for long-term capital appreciation. Let's talk numbers. Historically, FDVV has demonstrated a strong performance. Since its inception in late 2016, FDVV has produced an impressive track record. Its annualized return over the past 3 years has been consistently higher than the average ETF, showing its resilience in various market conditions. Now let's compare FDVV's yield and expense ratio to the average ETF. FDVV sports a dividend yield that's well above the average. This allows investors to enjoy a steady stream of income, which can be especially beneficial in uncertain market conditions. As for the expense ratio, FDVV's is relatively low, standing at just 0.29%. That's lower than many of its counterparts. A low expense ratio means that more of your investment goes towards purchasing assets, rather than paying for the fund's operation. This can have a significant impact on your portfolio's long-term growth. But FDVV is not just about high dividends and low expenses. It's about strategy. The fund uses a quantitative approach to select stocks, focusing on high dividend yield and sustainability. This approach aims to provide a reliable income stream while also offering the potential for capital appreciation. So, why might FDVV be a good fit for investors seeking high dividends? Well, it's simple. FDVV provides access to high-yielding stocks from a diverse range of sectors, and it does so with a low expense ratio. Its historical performance also speaks volumes about its ability to navigate through different market conditions. In conclusion, the Fidelity High Dividend ETF, or FDVV as we fondly call it, offers a unique blend of high-yielding stocks, making it an intriguing option for income-focused investors. It's not just about the dividends, it's about the potential for growth, the strategy, and the resilience. And that's what makes FDVV a standout choice in the world of high-yield ETFs. FDVV offers a unique blend of high-yielding stocks, making it an intriguing option for income-focused investors. If you're looking for a way to enhance your income while also having the potential for capital appreciation, FDVV might just be the ETF you've been searching for. Last, but certainly not least, is DLN or the stability. Let's take a moment to examine the delivered a solid performance. It has outpaced 0.5% can significantly boost your investment returns of income through dividends. This balance between growth dividend payers offers a mix of stability and income potential. Large cap stocks are typically considered more stable and less risky than their smaller counterparts. This makes DLN an attractive option for investors who prefer a blend of growth and income with a dash of stability. Let's take a moment to examine the unique features that set DLN apart. First off, DLN is a fundamentally weighted ETF. This means that its holdings are determined based on the annual cash dividends paid by the companies. It's not about the size of the company, but the size of the dividend that matters here. This method offers a fresh perspective, diverging from the traditional market cap-weighted approach. Now let's talk about performance. Over the past decade, DLN has consistently delivered a solid performance. It has outpaced many of its peers and even the broader market in certain years, but remember, past performance is not indicative of future results. It's always essential to do your homework before making any investment. Let's dive a bit deeper into the numbers. DLN's dividend yield currently hovers around 2.5%. This is slightly higher than the average ETF yield, which typically sits around 2%. It might not seem like a huge difference, but over time, this extra 0.5% can significantly boost your investment returns. But what about expenses? Well, DLN boasts an expense ratio of just 0.28%. This is lower than the average ETF expense ratio, which is around 0.44%. Again, this difference might seem small, but every fraction of a percent saved in expenses can add up to a substantial amount over the long term. At its core, DLN is about stability and income. It's an ETF that offers both growth potential and a steady stream of income through dividends. This balance between growth and income can make DLN an attractive option for many investors. However, as with any investment, there are risks involved. The value of your investment in DLN can go down as well as up. It's always crucial to consider your own risk tolerance and investment goals before diving in. In conclusion, DLN stands out with its unique approach to stock selection, solid performance record, and competitive yield and expense ratio. Its focus on large-cap dividend payers offers a mix of stability and income potential, making it a compelling choice for investors seeking to balance growth and income in their portfolio. DLN's focus on large-cap dividend payers offers a mix of stability and income potential. Now that we've introduced VIG, FDVV, and DLN focuses on high dividend-yielding companies providing an yield is the income return on an investment. Expense ratio is another crucial factor to consider from investors. Now for performance. Allowed it to capture some of the upside of the growth-focused most suitable choice. However, remember, dividend growth strategy favors companies that are financially healthy and growing. In contrast, FDVV, the Fidelity High Dividend ETF, focuses on high dividend-yielding companies providing an attractive income stream for investors. FDVV's strategy is more of a dividend yield approach, emphasizing income over growth. DLN, the Wisdom Tree U.S. Large Cap Dividend Fund, uses a fundamentally weighted index methodology, selecting companies based on their annual cash dividends. This strategy is a blend of the two, balancing both growth and income. Next, let's look at the yields. Remember, yield is the income return on an investment, expressed as a percentage of the investment's cost or current market value. VIG's yield is generally lower, hovering around 1.5% to 2%. This is because VIG's focus is on dividend growth rather than high yield. FDVB, with its high dividend yield strategy, unsurprisingly has a higher yield, typically in the range of 3% to 4%. DLN's yield is somewhere in between, usually sitting around 2.5% to 3%, reflecting its balanced approach. The expense ratio is another crucial factor to consider. It's the annual fee you pay to own the ETF. VIG, being part of Vanguard's low-cost lineup, has a very competitive expense ratio, usually around 10 basis points or 0.1%. FDVV's expense ratio is a bit higher, typically around 29 basis points. DLN's expense ratio is the highest of the three, usually around 28 basis points. While this difference may seem small, it can add up over time, especially for long-term investors. Now for performance. Over the past decade, VIG has delivered solid returns thanks to its focus on companies with consistent dividend growth, many of which are also industry leaders. FDVV, despite its higher yield, has generally lagged behind VG in terms of total return. This is primarily due to its focus on high dividend-yielding companies, which are often more mature and slower growing. DLN's performance has been somewhere in the middle. Its fundamentally weighted strategy has allowed it to capture some of the upside of the growth-focused VIG, while also benefiting from the income provided by the yield-focused FDVV. So, which of these ETFs is the right choice? Well, it depends on your investment goals and risk tolerance. If you're looking for consistent growth and are willing to accept a lower yield, VIG might be your best bet. If you're after a higher income stream and are less concerned about growth, then FDVV could be the way to go. And if you're looking for a balance of growth and income, DLN might be the most suitable choice. However, remember, past performance is not indicative of future results, and it's crucial to do your own research before making any investment decisions. As we can see, each of these ETFs offers a unique combination of growth and income, making them all worthy of consideration. We've journeyed through the ins and outs of VIG, FDV, those who are looking for a steady income stream, coupled with these that appear undervalued based on their fundamentals. To large-cap dividend payers also makes it a diverse. And if your aim is to maximize dividend yield while making 3 ETFs today, the world of investments and discipline. Remember, the right ETF, or VIG. It's an ETF that focuses on companies with a record of growing their dividends over time. This makes it a great choice for those who are looking for a steady income stream, coupled with the potential for capital appreciation. VIG's emphasis on quality dividend growers can offer a buffer against market downturns, providing an aspect of stability in your portfolio. Next, we ventured into the realm of the Fidelity High Dividend ETF, or FDVV. This ETF targets high dividend yielding companies, which could be a boon for income-focused investors. FDVV's methodology also incorporates a value tilt by selecting companies that appear undervalued based on their fundamentals. This could potentially offer a double whammy of high income and capital appreciation if these undervalued companies revert to their fair value. Lastly, we explored the Wisdom Tree U.S. Large Cap Dividend Fund, or DLN. This ETF offers a unique approach by weighting companies based on the total dividends they're expected to pay in the coming year. This strategy could lead to a higher yield compared to market cap-weighted ETFs. DLN's broad exposure to large-cap dividend payers also makes it a diversified choice. potentially reducing the risk associated with individual stock investing. Now, you might be wondering, which one is the right ETF for me? Well, that largely depends on your individual investment goals, risk tolerance, and time horizon. If you're an investor seeking a consistent income stream and capital growth, VIG's focus on dividend growth might appeal to you. If you're a value investor looking for a high income and potential capital appreciation, FDVV could be your pick. And if your aim is to maximize dividend yield while maintaining diversification, DLN might be the right choice. Remember, investing is not a one-size-fits-all endeavor. It's about finding the right balance that aligns with your financial goals and risk appetite. Whether you're a seasoned investor or just starting out, these 3 ETFs offer unique approaches to dividend investing that could potentially enhance your portfolio's performance. Before we close, it's worth noting that while we focused on these 3 ETFs today, the world of investing is vast and ever-evolving. There are countless other ETFs out there, each with its own unique strategy and potential benefits. So, continue to educate yourself, stay curious, and keep an open mind. I hope you found this journey through VIG, FDVV, and DLN insightful, and that it sparked your interest in exploring the opportunities that lie within dividend and growth ETFs. Remember, the key to successful investing lies in knowledge, patience, and discipline. Remember, the right ETF for you depends on your individual investment goals and risk tolerance. Don't forget to subscribe, like, and share this video to stay updated with the latest insights on ETF investing. Thank you for watching.